Okay, so let's take a look at this case. I think it goes without saying that nonprofit is a very important chapter. Okay, and I think I made that clear in last Monday's video, the web option, that definitely there will be a question from this chapter. So we went through quite a long, detailed, review of the different handbook sections within Part 3. So we looked at 8 sections in the handbook. And what I like about this case is that it kind of highlights those 8 handbook sections. So that's why I picked this case, is it goes through the 8 different sections of the handbook. So I thought what we would do is we'll go through every paragraph and we'll highlight what are the issues. Okay, and I also told you all that there will be a case on the exam, and I'm not saying which chapter will be the case, but I thought this case would really be a good way to highlight those 8 sections of the handbook. Okay, so the question says, prepare a memo to the board of directors recommending with supporting explanations, so you're supposed to analyze the issue and provide a recommendation of what changes in accounting and reporting are required in order to comply with GAAP. So by that statement, it implies that GAAP isn't followed by this company or by this organization. And we want to fulfill our stewardship reporting objective. And stewardship is important for nonprofit because clearly, right, we have to be accountable, or the management has to be accountable of where the money is being spent and whether the contributions objectives, the contributors' objectives are being met. Then it says assume that the deferral method is used for contributions. Now, normally in a case, if this was a case, we don't tell you which method because sometimes a nonprofit may utilize both the deferral method and the restricted fund method, depending on the objectives. But in this case, it clearly says that the deferral method is being utilized. Okay, so let's go through each paragraph. And that's what we're going to do. We're going to analyze on a paragraph-by-paragraph basis. So the first paragraph talks about the role. So you are the treasurer, and on the board of directors of Canoes R Us community-based service, and an NFPO which provides canoeing lessons and rentals to various community groups. So that's their objective. They do 2 things: canoe rentals and lessons. Okay? So it's important to highlight that because that will dictate, right, perhaps, if they're getting contributions for those 2 main objectives and there's a specific endowment, for example, on one of them, then you might want to recommend restricted fund method. The case says use deferral. But if the case didn't say that, those 2 objectives would have been superly clear that that's if there's specific funding or pledges or any type of fundraising that they're doing for 1 or 2, that might make sense to recommend deferral. And let's say if the nonprofit decided to, I don't know, do a 3rd objective by maybe doing something a little bit different than the main 2, you might want to recommend deferral if it's a one-time type of contribution. So that's how, because I got an email yesterday from a student that says, I'm still confused about when do we use deferral and restricted, and can a nonprofit use both? And the answer is yes. The restricted fund method is used if funding are very specific to the 2 main objectives. If there's a 3rd or 4th fundraising, or there's a 3rd or 4th, event, right, that this company, this organization decided to put out, and it's really a one-time thing, it's not material, it's small, it's, right, it happens maybe once a year, it's not really their main objective, then you can recommend deferral for those 2. Do you see what I'm getting at, right? So I want to make sure you understand the difference between the 2. Now it says canoes are us is a large, so the word large means what? The 4431 and the 4432 means that you are to capitalize and amortize capital asset. But the way to test that, obviously, is to assume that the average contribution revenue over the past 2 years is over 500,000, you become a large anyway. But here they tell you they're a large, so which we know we have to capitalize and amortize capital assets, right? Then it says, with annual donations and grant in excess of $2 million, for the past several years, the Canoe program has been funded through lessons, members' contributions, and donations from the community. Canoes R Us relies on a large number of volunteers. So first of all, we need to deal with the accounting for volunteers. Okay, so that's definitely one of the issues that we've got to make sure that we address in this memo. Okay, and I'm just going to put that as a placeholder. So when I do a case, I normally kind of read the required first, and the required is very helpful. So, and if it wasn't helpful, normally I read a paragraph above the required. And that gives me a bit more on what exactly do they want me to do in this memo. Okay, but of course I read the case, so I know that we're just going to go right into the case, right? So I need to make sure that we need to address the accounting for the volunteers, including volunteers for solicitation of donations. So this would be those campaign callers. Remember, I mean, I'm sure you've gotten those lately over the holidays. Right, Sarwat? Yeah, you know. So those are volunteers. How do we account for them? So we know those ones we don't measure, right? According to our handbook, because it's difficult to determine the fair value, particularly for volunteers, we don't record. We don't attempt to value, right? And performance. So these are solicitation. And these are bookkeepers, right? So this one is disclosure. No fair value, no recording, right? So we don't record it because of the fair value issue. It specifically states in the handbook. But this one is, we can record if it's reasonably measured. It's something that the Canoes R Us would have needed to, right? And is this a requirement? Of course it is, right? You need to have statements. So this one here could possibly be recorded, right? At fair value because it is measurable and needed. Now, I'm not using the right terminology in the handbook, but you can certainly see that in the lecture notes. The lecture notes was clear on the two conditions that you need to meet. One is it has to be reasonably measurable, and the second one is it's a service or a good that they would have normally purchased if it wasn't donated otherwise, right? And that's clearly what it says in our standards. So this one I would record, this one I would not record, okay? And again, there needs to be a little bit more teeth in the language and a little bit more explanation, but that's essentially what we're looking for, okay? Then it says, volunteers, instructors are allowed to borrow canoes for personal use for a nominal rental fee of $25 as long as there's a spare canoe available. Now, if this was a comprehensive case, right, it deals with tax and audit, and I would look at controls, I would think about taxable benefit, all these things that you learn throughout this was an integrated course, but this is clearly just the accounting. Right? So it would be reasonable if you went off in those areas, but clearly that's not required. Okay? Now it says, as long as there are spare canoes available. So I might want to do something like internal controls. I want to make sure that we monitor where the canoes are, and you'll see a bit later in the case that there's no tracking of these canoes. Okay? So this will be the internal control related to the asset called canoes, right? Okay. All right. The board has recently set up a program in conjunction with our local community to provide lessons and rental to various groups for low-income family. The municipal government and the lottery commissions have announced that they will, in total, a one-time grant of $250 this year for the canoe. Now, again, you need to think about the constraints here. Are we using Part 3 gap, or are we using PSAP? So that would be my third one, right? So Part 3 versus PSAP. And it would have been something I would think about only because the donations from the government, if it's significant enough, they have to use PSAP. Because remember that chart I showed you at the end of last Monday's lecture, which showed you if you are an entity that's government funded, right? What do you use? Do you use Part 3? Do you use Part 1? Do you use normal? Do you use PSAP? Remember that chart? Please review the chart. Okay? Okay. Now, Part 3 versus PSAP. In this case, because it's only $250,000 funding, okay, from government, versus, remember it says donations, there are $2 million annual donations. It's not material, right? Versus 2 million donations in total. It's not material, so guess what? I'm going to say we're going to use Part 3. So there's got to be a logic. You can't just say we're going to use Part 3 because it's nonprofit. Well, it is a nonprofit, right? Because their objective is one more of social, right, as opposed to economic. But at the same time, you've got to understand that they have a choice, perhaps to use Part 3 or PSAP. In this case, we would recommend Part 3. So it would only require 1 or 2 sentences in this case. But again, that would trigger that thought process, right? Okay. By the way, we're doing, for those that came in late, we're doing case 12-3. First of all, thank you all for coming. It's nice to see everybody. I know I've taken you out of your busy week studying for D50, I'm sure. By Saturday, you'll get your life back, right? Don't you get your life back after D50? Oh, now all these coughing and... Okay, I get it. It is your first exam, isn't it, you guys? Yeah. So you get the first one out of the way. Second one, which is the first one? Oh, finance on Friday? On Friday night? Ooh. Okay. So I'll bring coffee. All right. Now, the $250,000 is the grant. The $250,000 grant has a number of conditions. The first one is $50,000 to purchase a new truck. So what would you do? You would debit cash, or sorry, 50 in credit deferred contribution. Because they told us they're using the deferral method. So they would do that, and we would amortize the deferred contribution over the life of the truck. So that's what we would do. And that's going to be what's flowing in my head right now, right? So I'm reading it. I know I've got to address not just the accounting for the contribution, but also the asset, because now I've got this capital asset I have to deal with, right? Okay. So now I've got to deal with the capital asset. First is a $50,000 truck. And of course, we capitalized and amortized, right? right? So we know we have to do that because we've already established they're a large NPO, right? The 150 is to purchase new canoes and safety machines. So obviously I deal with the 152. So this would be 50 plus the 150 because this is, right, truck and canoes now. So I want to make sure I indicate to the treasurer. Now, I don't have to do journal entries because remember, you're talking to the board, so you've got to play your role appropriately. But at the same time, it's in, what's going through your head right now is what is the accounting and what's the, what does the balance sheet or the statement of financial position looks like and how do we deal with it on a go-forward basis, right? And the $50,000 is restricted to cover operating costs such as salaries. So that one there, so I've got the 50 and the 150, and the second one is going to be debit cash, credit revenue. Why? Because it's paying for current expenses. So this is to match. What? What was that?
That was my phone. Sorry.
Oh, was that your phone? Current expenses. Okay. I thought you were asking me to do something like move it, right neater or something. Do you say that? Yeah, you know what? I'm trying to get through a lot of questions, so I apologize. I'm hoping that you can replay and just listen through, right? But I'm going to try to write neater, slower. Is that okay? Meredith? Samantha? Are you not impressed I remember your names now? After all these years, finally, the last class, I remember people's names. Okay. Now it says an external audit by independent auditors must be conducted at the end of the year and report must be submitted to the municipal government. The book and records of canoes are not previously audited. So again, if this was an audit case, and so I would kind of get into that whole first-time audit engagement, right? So this would be a great comprehensive case. And this is typically the kind of case that you would get at the, obviously, professional level, right? So you go through and you think about what are the tax implications, what are the internal control, what about the audit implications being a first-time audit, will there be a qualification of the audit report, and what would the audit report look like, what would be the extra paragraph that you need. All of those things should be rushing in, and hopefully you can decipher through, and then when you write it, you can bring it all together. But this is just an accounting case. Okay. During a recent funding campaign, Canoes R Us raised $45,000 in cash and $20,000 of pledges. So this one is, the sixth issue is pledges, right? And pledges are receivables, aren't they? Right? Pledge receivables. So first of all, can we set it up? Okay. Can we set up the receivable? So what were the conditions? This is 4410, right? Contribution receivables. And do we need to set up an allowance? And do we have the know-it-all, the wherewithal to know what to set up? Do we have that knowledge? Is this the first time we're doing this? So these are the questions you would ask. These are the things that you would need to say. And again, it's all about the value of this report to the board, right? You need to be clear in your concerns about setting up that receivable. Because what are you doing? You're debiting a receivable, you're crediting a revenue, correct? And that revenue is going to be reflected in the current year's statement of operations. Okay? So these are the things that you would be concerned about, right? And of course it has to be audited, which means that those allowance has to be, has to be reasonable and supported. The pledges are expected to be received by the middle of next fiscal year. In addition, a local manufacturer has donated a canoe valued at $2,500 to the program. So again, this is the donated. So this is donated services, right? So this is services and goods. And here, the third one is this $2,500 canoe. So the third element to this issue was this manufacturer that says, I'm going to donate this canoe. And again, we've got to establish, can we set up the asset? We would normally would have bought it. And the answer is yes. So this one I would set up too. So remember, the only one that the handbook says you cannot set up is volunteers, because it's difficult to measure, difficult to account the fair value. But obviously, the service of a bookkeeper is something you would have purchased, so you know the fair value of that, right? All right. The cost of fundraising for the year was $20,000, which includes salary of one part-time employee, the cost of preparing and mailing brochures to past and prospective donors. The brochures describe the program, blah, blah, blah. Here, the seventh issue. So that's what I like about this case. It has everything. Okay. This one is it's called fundraising expense allocation. This is section 4470. Do you remember that? That was the most recent, latest edition. That was about three years ago. Remember, 2009 is when we set up the Part 3 gap, and this would have been something in 2010, 2011, is when this is the most recent addition to the handbook. And this one talks about whether we need to, if we want to allocate to the different programs. And remember, they have two main programs, correct? And if they're going to fundraise it and they want to be able to allocate it because there's different eyeballs for each of the objectives, then you might want to do a disclosure on the fundraising expenses and how did you allocate to different objectives. So this is all about disclosure. Okay? Now, you're probably wondering, where am I doing this? So some students, they like to do their notes, just like I've done here. You notice how I don't write lots of words. I just write little points and arrows and, you know, kind of like question mark, underline, whatever it is. That's how I plan my case. And then just before I write the case, I read the required again, taking a look at what I've got, and attempt to rank. I've got to be able to, because I don't have that much time, right? Right? You really don't have a lot of time. So you've got to then spend, where are you going to spend most of your time in analyzing the issue, and then the rest of them will just be bullet points and under the other category. Because it's meant to be, again, in writing these cases, and again, I want you to take away this point is, when you do this, I like doing mine on a sheet of paper. Some of you will do it on the side or the margin of the question. And that's fine too, whichever way works. But at the end of the day, before you start writing, you need to step back and say, okay, I got to address the user's needs, the constraint, that's a given. Then I got to say, okay, I've got 7 so far. I only have time to do 4. Which are the top 4? And usually you set it based on materiality, or you set it based on a user specific request, and then just go through each one. Okay? So let's finish this case. We're almost done. Now, it says that when you review the financials, you discover that the books have been kept by a modified accrual basis, whereby cash basis for initiative may be cash basis is used for inflow, but payables are accrued for outflow. So basically they're saying revenues, they record revenue when cash comes in, which means those pledges are not recorded, and expenses are accrued. So obviously this is a problem with GAAP, right? So I'm going to come back to part 3, number 3. I'm going to say, okay, I'm going to use part 3, and what does part 3 say? We have to use accrual. So this is where I'm going to add that to it. Okay, so it's not really a separate issue, but it's part of the whole discussion on which standards to use. And our standard says we have to use not the modified accrual, but the accrual basis of accounting, right? Now, I wouldn't just say we're going to use the accrual, but why? Always ask yourself, in every case, the word because should be in front of you. Because every time you say we must use accrual basis of accounting because it's required by GAAP, well, okay, yeah, I get that. But what's that additional comment you need to make to be that highly competent in the scale of assessment key, right? That's what they're looking. They're looking for why. Because you want the statements to make sense. You want the statements to show what monies have come in, not when you got the monies, right? When these pledges and when these events happen, you got to record them when you can measure them. There's got to be some sort of matching, right? So remember, the matching is opposite, right? It's not expenses to revenue, it's revenue to expenses. The fact that you're accruing the expenses, you've got to match the revenue against those expenses, or else stewardship reporting, the objective financial reporting for nonprofit, doesn't make sense if you use modified accrual. So that would be the secondary thing I would say. Other than the fact that it's accordance to GAAP, I would also say, you know what? It makes more sense to use accrual because of this reason. And all it needs is 1 or 2 sentences. And then you just have to make sure you execute it concisely with why, and then you move on to the next issue. Okay? If you can master the skill of case writing and communication, you can write any exam. Right? You can do any professional exam because that's what they're looking for. And these cases are rigged so that you don't finish. But so what they want to see is, how did you able to address the issue in a way that would be helpful and in a way that you can address it within a short period of time. If you can do that, then you can do anything. You can pass the UFI. And you don't have to have deep knowledge, right? They're asking for newly qualified CPA. That's the level of knowledge, which means that pensions accounting, it's not newly qualified CPA, right? The detail of Part 4 is not required. The detail of PSAT is not required because that's not what a typically new qualified CPA would need to know. So that's essentially why I mention that, is because this exam is set so that I want you to walk out of this exam knowing that you have the core knowledge. Not a deep knowledge, a core knowledge of all the materials we covered in this course. So it took me a while to come up with questions that, to me, are deemed to be very important from a professional level. At the same time, I want you to make sure you understand those core. So there are 5 sections on the exam. One is multiple choice, and I believe there are 14 of them. Now I remember. I think, can you do me a favor, Kyle? Can you do 14 times 2.5? Does that give you 35? I think it does, right? Okay, so there are 14 multiple choice, not 25. Rumor has it I had 25 in there. Really? 25, they said. Some of them said 20. I said, no, I don't even know. 14. There are 4 bonus multiple choice. So that's part 1. One of them will be a case. I can't tell you what chapter. Okay? One of them, as I said, will be chapter 11, which is the translation of the financial. So that will be your gift. That will be your giveaway. Got to nail that, right? You got to understand how to translate. And all you need is to practice those 3 questions that we took up in class. Okay? Understand when to use integrated. Understand when to use self-sustaining. Correct? And that's important from a professional level, right? And the other two will be a surprise, but they will be short questions. Okay? So that's all I'm going to say in the nature of the exam. So there's 5 parts to it, okay? One will be multiple choice, one will be a case, one will be that translation, and 2 short. And short, 15 marks. So I want you to have an opportunity to deep dive on certain things and not put all your eggs in one basket, so to speak, by having that one big question. Okay? Does that make sense? Please don't email me. What did you say? Did you say one big? Did you say 30 multiple choice? I heard 25. So I had to clarify that. And I don't mind answering questions, as you all know. But they're bad rumors, Justin. Bad rumors. Okay. All right. Let's move on. Let's finish this case. Capital expenditures have been expensed in the year of purchase. We know that's not right. So we know that we need to address the expensing. Now, remember, this is the first year of audit, which means we have to do retroactive, right? Retroactive, because we need to get that list of capital assets, because they've got to go back and actually capitalize those capital assets and then re-amortize them, right? So we got a huge problem here, which means if this was a full case, you would address the audit implications. What audit procedures would you need to establish the qualification of the audit report? So I don't want you to think in silos here, because you guys, this is your last course really, right? Start thinking all of the stuff that you learned. I know you learn tax separately, you learn audit separately. That's why Professor Daya teaches a capstone course. It's an awesome course. You got to take that. Painful as it is, but it's a segue for you to get into case writing. Who's taking that right now? Is it offered? No. But that was a great course if you haven't thought about it. I know you probably don't have room, right? It's the capstone. It used to be called D56. I don't know what it's called now. D80. Is it canceled? Oh, that's too bad. Because that course really was a prep for the UFI. And if you can find that course anywhere else, do take it. And I know it's painful because it's cases, right? But you got to practice. All right. Then it says, you've also been advised that several instructors have unpaid rental accounting ranging from $50 to $400, and it appears that no serious effort has been made. So this is the internal control issue that I talked about, not only related to the asset, the controls, but also the controls related to revenue. So unpaid from the instructors. So what are we doing? We are, now the financial effect is 0 because we're not recording the revenue clearly, but we're also not recording the benefit of it, right? Because clearly it would be one of those taxable benefit, right? And check with your tax act, and tax act says you've got to tax those taxable benefits, right? Okay. Then it says, in discussion with the previous treasurer about how the new grant and other funds to be used accounted for, you discovered that she is very opposed to any changes in the way the accounting records are kept and financial statements are prepared. She said that changes will make it difficult for companies comparative programs to understand how the funds are being used. She's very active in setting up the organization. So here you have to re-educate. You've got to explain. So that paragraph really is evidence or hook. We call it hook or trigger in a case that allows you to explain why, right, deferral method is important, right? Why is this deferral method important? Why are we doing this? Why is modified accounting not important? That paragraph is why, because sometimes you'll say to me, well, I don't understand, why did you discuss, why were there marks on explaining when you tell me you don't need to explain, right? Because it depends on well, that was that paragraph that says you got to explain, okay? So I'm going to post a solution to this case, but I wanted you to really go through the cases. It wasn't that hard. You can see that I took it up fairly quickly and easily, but you've got to then, practice your case writing because that's going to be what's going to be tested. Okay? Are we good, you guys? Okay, let's take a look at 11-9, please. Any questions on nonprofit before we move on from 12? Yes. Afra, yes. Close enough.
Well, just with the case, like, would we expect it to identify the key issues, or if we on the exam we have to identify all of the issues?
The case will be, if there was a case, it will be your typical case where we describe the scenario and it requires us to prepare a memo. So I will leave it up to you to determine which issues are more important, how to address those issues. So it would be your typical case. Okay? It will not be similar. It's not similar to the midterm exam. The midterm exam was very, I just want you to write and explain. This is not that way. Okay? Does that make sense? Yes, sir.
In terms of the auditing, we don't need to touch on that, right?
No, this is a financial accounting course. But if you were thinking about internal control, audit, taxable benefit, you're probably on the right track when you read that case. Right? Remember that this case was a much more comprehensive case, but they just narrowed it down to the nonprofit section, right? Okay. All right. 11-9, please. I'm going backwards, you notice, right? Okay. Please read. Okay, so let's read the required first. It says, Part A, assume Tarzan is an integrated operation. Prepare the financial statements in Canadian dollars. So we are given the December 31st, year 4 balance sheet income statement of Tarzan. And we need to translate it using the integrated method. Okay, show your calculation. And Part B says, if the net realizable value of the ending inventory was $350,000, what would be the Canadian dollar equivalent to be in inventory? So this is like testing the lower cost of market, basically. Okay? Now, you might want to redo this question using the self-sustaining method. Again, it requires you to practice, right? So an opportunity to do that. So that's the required. We need to do the integrated method, which means we need the temporal method. Okay? Now, let's read a question. So DOM, a private company, has a sub called Tarzan in a country that uses TAR as its currency. Before its 100% owned subsidiary can be consolidated, the financial must be translated from TAR to Canadian dollars. However, the person responsible for the translation has quit suddenly and left you with the half-unfinished job. Here are the information. So we're given the balance sheet and the income statement. Then here's the additional information. The first one is they told us about the 2 buildings and 1 piece of land. So I'm just going to read it really quickly. I just want to make sure I want to go through all my additional information. The second one is they gave me opening inventory. They told me when the inventory, the opening, when it was bought, what exchange rate that opening inventory relates to. They used the FIFO inventory system. And they told you that the inventory was at 3.5. So this is, they're giving me the exchange rate using the indirect method. Did you notice that? Which means I need to divide TAR into the currency to get me my Canadian dollar, right, you guys? Don't make the mistake of multiplying, right? So make sure you know indirect versus direct quote. Number 3, they told me about the notes payable. Number 4, they gave me the retained earnings. Or they gave me the opening retained earnings. It's already giving me the translated amount. Remember I said to you guys in class, the 3 questions that we did in class, the beginning of the year was the year of acquisition, right? So we only did that 1 year. But in this question, this has been going on. So that's why the Canadian amount of retained earnings had to be given to you, okay? Because that you cannot calculate that, okay? Then it says other expenses, blah, blah, blah. Okay, so you know what? I have a problem with this question. I don't know how to calculate the foreign exchange gain or loss because I'm not given the opening non-monetary position. So how the heck am I going to do this? Well, let me show you. It's a matter of just figuring out the missing information. So the first thing you would have done in the 3 questions that we did in class was we attempted to calculate the gain or loss, right? Here we don't have that because we don't have the opening. Okay. So this is why I like this question, is because it approaches the translation in a different way. Normally the 3 questions that we did in class, P11-1, 2, and 3 starts with, right, the calculation. So let's do this together. So they want me to do the translation. So this is TAR, FX, rate, and Canadian dollar. Now, when I do one of these questions, it's not so much as getting the right answer, it's showing the work, because sometimes we will give part marks in only certain calculations. Okay? So make sure you do that. So let's start with land. Land is the first asset. It was $500,000. Now, given the fact that the land, okay, it says land and building 1 was acquired when Dome formed Tarzan, and that was at the exchange rate of 2. Which means that this has got to be 250, right? Because this is an indirect quote. Okay? So it was clear as, remember, right? Now we formed the sub, so we don't have that idea of that which exchange rate do we use from the date of acquisition, the later of the 2, not the higher of the 2, the later. That means a date-wise, which exchange rates to use, okay? Next, building number 1. Now, the building, they gave us 1 building, but we know building number 1 and building number 2. Building number 1 has to be 300, right? Which means that building number 2 has to be 500. Because the total building is 800, right? Building number 2 was 1 to 2 tar. Now, building number 2, we're told that it was acquired when the exchange rate was 1.32. Or 3.2, sorry. Okay? And this gives me 156, 250. Okay? Under the integrated method, you've got to track each individual building, and we'll see in a minute when we do the depreciation, we've got to make sure that we track what depreciation relates to which acquisition, because it will matter, right? The accum, we're given 300,000, and it says the cumulative amortization to building 2 was 200, which means that building number 1 must be 100. And of course, we would have to follow, right? In a way, integrated method is probably the more complex. That's why they used it in this question in terms of translation, but it is the easier one for calculating purchase discrepancy, right? The translation of that 8 acquisition differential. It's a self-sustaining method where it's easier to translate, but it's difficult or much more complex to do the acquisition translation of the purchase price discrepancy, the acquisition differential. I think you saw that in 11-3. So when we calculate the goodwill write down, okay? So just remember that. Now you got inventory. Inventory, you're told it's 400,000. And we're told that the inventory in item number 2, its exchange rate is 4. Now, we're going to use this to compare to the lower cost of NRV, right? So that's part B to the question. So we're going to get to that a bit later. Okay. Next, you got AR. 200,000 is AR, and cash is 100,000. And both has to be translated at the balance sheet rate, which is 4.1 according to the chart, right? So the total asset is 616,920. Okay, so now we look at common shares. It's 300,000. And that one there is when the company was formed, which is 2.0, right? Because we're told that the land and building was acquired when Dom formed Tran, Tarsan. So that would have been the acquisition date, right? Retained earnings beginning was $750, right? And this is given to me. Now profit. So what's the profit? 150. Now I don't know what this is because I don't have the FX gain or loss, right? I'm missing the FX gain or loss. Notes payable and AP are the last 2 items. And this one has to be at the current rate. Now, I know that this has got to be 616,920. So this has got to be the same. So this means that this has got to be 126,565. And from there, I can figure out the gain or loss. Right? Because now I have that net income, which includes the gain or loss. And I'm about to translate the net income. Okay, so this has got to be the profit. So this is the plug. Now I'm about to figure out what the gain or loss is for translation, right? So let's do this next. Okay, let's move on. Let's look at sales. 5.2 million. We're going to use the average. Now, cost of goods sold. That's why this is harder, because you got to break it out into its component, right? beginning inventory was 500,000. That one we're told is 3.5. Now, we have purchases. In the second bullet point, we're told that purchases was 3 million. 30% is from parent. And that one, we're told that it was translated at 232,558. So that would have been the parents, right? Because we obviously have to eliminate. Then you've got the next must be from outsider at 70%. And we have to assume it's average. And we're told it's average, right? So I've got my goods available for sale, gas. And my ending inventory, which I just did on the balance sheet, is 4, right? Okay. So now I can calculate my gross profit, which is sales minus cost of goods sold. Other expenses. We're told in other expenses was 1.9 million, but I'm going to exclude depreciation in a minute, so it would be 1870 without depreciation. And that one we're going to use the average. Depreciation, I've got to figure out how much of that $80,000 relates to the building 1 and the building 2. Right? So we know that 3/8. Now, because, look at this. The building has got 3 and 5. So this is 800,000, right? So I'm just saying 3/8 of that is building 1 and 5/8 of that is building 2. So this is 30,000 and 50,000. And I'm going to use the exchange rate equal to the balance sheet, right? And of course, if this is self-sustaining, it's a no-brainer. Everything is average, right? Now, my net income was 126,565, right? So this must be the FX gain. So this one is great because you don't have to calculate. So if you're not given the beginning and ending, you still can figure that out, right? Does that make sense, you guys? Now for part B, it's asking us for the lower of cost to market. So again, we've got TARS, FX, Canadian dollar, right? For inventory at cost, we had 400,000, and we had 1 to 4. Market is 350. So although there's a write-down for in the local books, there's also a write-down in Canadian. And this is the write-down we need to book. Right? So you would write down the inventory, and of course you can only write back up to the extent of write-down from previous period. Right? Does that make sense, you guys? Are we good? Okay, moving on. Any questions on translation, chapter 11? It's not difficult, right, you guys? But it is a bit tricky, and I just did this question, which is a bit trickier. All right? Okay, let's take a yes, Samantha. Do you mean this one? So if I take 300, no. Sorry. This is the beginning. I'm sorry. You're not supposed to add these two together. This is the ending retained earnings. And we're told that because there were no dividends, the beginning retained earnings is really 600, isn't it? Yeah. So this really is 600. Because the total of this is 750. And that was given to us. Do you see what I'm getting at? Sorry, I got excited and I put 750, but what I meant to say is that is the ending retained earnings, which means that there are only two things that could affect it from the beginning or to calculate back, because you got to deduct the profit, right? Okay, thank you, Samantha. Does that make sense? Okay. Next question, 10-12, please. Okay, for 10-12, I think from chapter 10, and somebody asked me a question, and you notice why I'm going backwards? Is somebody asked me a question the other day, says, how do I study for this course? And I said, I don't know what I said. I said, go backwards. Don't start from chapter 1, start from the end. And then if you have time, go back to materials before the midterm. So I figured, you know what, I might as well practice what I preach. So let's take up the questions backwards. That's probably why I'm doing this. Okay? So this is the hard part of this chapter, chapter 10, is this whole idea of hedging, right? So this question, 10-12, has multiple parts. The first part is asking me to prepare all journal entries. And the question above, it's saying that assuming that this is a cash flow hedge. So that's what the question says, right? So part A says, assuming prepare a journal entry, meaning using a cash flow hedge. Then part A, sub 2 says, hey, what does the balance sheet look like? And that's typical because we want to know, we want you to show me that the contract, the forward contract, you're supposed to only put the net, right? Because that's your net exposure for that commitment, isn't it? Because you don't record commitments normally, except if you're using it as a hedge, then you have to record the commitment. Part B says, what happens if there's no forward contract? In other words, if it's an unexposed transactions, what would it look like? Then part C says, hey, why don't we pretend it's a fair value hedge? I want to see the difference. Okay? And then part D says, hey, what if we use ASPE? What would the statement look like? So I'm not going to do D and E. I'm going to show you in the solution because we won't have time. So I'm just going to do A and B. Is that okay? And C. A, B, and C. All right. Okay. Don't be concerned. You'll see. You'll have the answer. Okay. So again, I'm going to use, just like I did in class a couple weeks ago, I'm going to do it side by side so that you can see clearly the contrast, right? And I'm probably going to solve the first part, the cash flow hedge first. Let's just get that out of the way, and then we'll move into the fair value hedge. Is that okay? All right. Okay. Let's read the question. On June 1st, year 3, Forever Young Corp. FYC ordered merchandise from a supplier in Turkey for $200,000, so Turkish lira. The goods were delivered on September 30th with terms cash on delivery. So we need to be able to buy, right, $200,000 Turkish lira, TL, right? Which means that my due from bank must be in foreign currency, right, if I'm going to hedge. Why? Because I need cash. I need Turkish lira to be able to deliver to a supplier, right? Then it says on June 2nd, year 3, FYC entered into a forward contract as a cash flow hedge to purchase 200,000 Turkish lira on September 30th, year 3 at a rate of 0.73. The year end is June 30th. On September 30th, year 3, FYC paid a foreign supplier in full and settled the forward contract. So this is not that much different than the question that we did in class. All right? Okay. So let's do this. On June 2nd, year 3, I need to set up the forward contract. Given the fact that I need Turkish lira to deliver to the supplier, I'm going to go and connect with an institution, normally a bank, that's willing to accept that risk. So I'm going to debit due from bank, and I'd like to put the word TL beside it to remind me that that is a foreign denominated receivable. And I'm going to use 200,000 times the forward rate, which is 146. I'm going to credit payable to bank in Canadian dollars, right? Okay. Make sense? Okay. When is the year end? June 30th, right? Because it says prepare a partial balance sheet, right? So on June 30th, which is the year end, what happens? Well, the forward contract goes from 0.73 to 0.725. So it gives me $1,000. Now, is that a loss or a gain? That's a loss, right? Because my receivable went down, right? If this is a cash flow hedge, it has to go through OCI, correct? So I need to debit OCI. By the way, what items go to OCI now? What transactions go through OCI? Anybody know? First, gains or losses through under cash flow hedge, right? Number 2, translation gain or losses under the self-sustaining method. What's the third one that we learned in chapter 2? Kyle? Investment, fair value through OCI or available for sale. Those are the third. The fourth, you learned this in CO7 or CO8. There's only 5 things that go in there, you guys. You should know these 5 things, right? The capital asset revaluation method, you guys. Come on. Jenny, please say yes. And David, what's the 5th one? You learned this in CO8 or CO2 now. Pensions. 5 things that go in there. You don't worry about pensions because, again, you're not responsible for that on a professional level. As far as I know anyway. And revaluation, right? Not that many companies do it, but they do. If they do, they go through there. And of course, the 3 that you are responsible for in this course are in this course, right? Okay, so we know that, right? You guys are just kidding me, right? You know it. Okay. David says, yeah. All right. Now, what did we do on September 30th? That's the day that we got the products. So now we're going to revalue, first of all, September 30th. What happened to the forward contract? It went up. Yay. Okay. So 200,000 times 0.74 minus 0.725 is 300,000. So now I've got debit due from bank. $300,000 credit FX. Oh, OCI. See, I only made a mistake. Right? Okay, so now what do we do next? So we're going to set up the actual products coming in, right? So first, let's debit the products coming in. And what is that, you guys? It's 148, right? It's 200,000 times 0.74. Now, I'm going to exchange, right, my monies so that I can pay this cash. So technically, I should have settled the forward contract first and then did the inventory, right? So now I got to settle. So I need to debit payable to bank in Canadian dollars, credit cash, and that was for 146. So I'm going to deliver to the bank 146, okay? And the bank's going to give me debit cash, credit, due from bank. This is the TL, right? And that one we got at 148. How do I know it's 148? Well, I've got 146, I set it up. Then I reduced it by 1, so that I'm down to 145. I increased it by 3, I'm up to 148. I got to settle it to make this thing go to 0. So that's what I need to do, 148. And of course, I deliver that money to buy my inventory. Now, I have an OCI. What's in my OCI? I've got 1,000 debit, 3,000 credits. I've got a 2,000 credit. So I need to debit OCI to make it go to 0. I'm going to credit inventory. Okay? Hedge accounting is actually not that difficult. All you have to remember is if it's a cash flow hedge, any gains or losses from translating the forward contract goes to OCI, and then it gets zeroed out of OCI when the actual hedged item occurs. Right? Okay. Hey, did you guys complete the online evaluations yet? Okay, if you haven't done so, can you please do that? Okay. I think it's due when? Thursday? So Friday the 5th? What day is today? The 3rd? Is today the 4th? Yeah, so it's due tomorrow, you guys. Okay? And I think we only have about 50%. We have a new tool now that we can track what percentage have completed. That's why I sent you guys that email yesterday. That's a new tool that we have. Does that make sense? Okay, I'm going to do the fair value hedge in red. Okay? So under the fair value hedge, the setting up of the contract is the same. Okay? And we need to fair value also the contract. So this is the same. And the entry is debit FX gain loss, in this case, 1,000, and credit due from bank. Why? Because under the fair value hedge, everything funnels through the P&L. Now, it also means that you've got to fair value the commitment. And in this case, we have a commitment liability. We're committed to a liability, right? When we buy that inventory in September, we have a liability. So we need to fair value that liability too. And you got to remember, under the fair value hedge, the intent is the gain or loss on the hedging item is matched against the hedged item. The hedged item is this liability, this purchase. So now we've got to then make sure that we also book a $1,000 gain because that liability is now less. Think about it. We now owe less. Right? So we've got a debit. So there's an additional commitment, liability, credit, FX gain. Okay, and that is the difference between 0.725 and 7.73. And you notice that this gain and this loss offset. And what we're going to show you guys is we're going to show a net balance, right? We're going to show that net balance of $1,000. Actually, the balance sheet will show. What does the balance sheet show actually? Well, actually, sorry, we're only in June, but at the end of June, we should show no liability, no receivable, right? Okay, in this area, but now we've got September to worry about. So under September, we have to fair value the commitment or the hedging item, and of course, we need to debit due from bank, and of course, we would to credit FX gain, and we've got to also fair value the liability, and the liability is now higher because the exchange rate went from 0.725 to 0.74. So now we owe more. Okay? So we debit FX loss, credit commitment liability, 3,000. So if you ever get confused or having one of those mental relapse, like I often do, there are times where I can't remember certain things, it's at the tip of your tongue. Remember, under the fair value hedge, the gain or loss is always offset. That's the point behind it. Right? Unless you have a transaction that is exposed. And of course, once we settle it, these entries are exactly the same. So this is 148, 148. The payable to bank will be 146. And the cash amount would be 148. And of course, we would have a debit commitment liability, credit inventory. So the difference between these two is that we're flushing out the OCI, but this one we do have a liability, so we do have an exposure for that commitment. Okay? Commitment, liability, inventory. It should be the same, right? Except instead of OCI, we're debiting commitment liability. Yes, sir?
The liability because we're buying, correct? If we were selling,
Correct. It would be a receivable.
Or an asset if
Yeah.
we were selling.
Correct. Okay. Okay, let's move on. So I only got 20 minutes. I'll post the answer to the rest of the questions, okay? If it's unexposed, it's just, you don't worry about the hedging item, right? All you would do is record the actual inventory purchased. Okay, the one thing I want to do next is 9-14, joint venture. The solution will be posted as soon as I get upstairs. Okay? So you'll have it hopefully immediately. Now, before we've got 20 minutes left, are there any other questions you have? Because I don't want to rush you guys out, but are there any questions at all that you have before we leave? So what I try to do is cover the main topics, right? Any questions, any concerns? Okay. 9-14. The first requirement A assumes that the transaction does not have commercial substance when Clifford transferred the equipment to the joint venture. So in this chapter, we talked about special purpose entity, right? So make sure you know that. Okay, and we talked about variable interest entity. Make sure you know that. And joint arrangements. And joint arrangement, there's basically two options. You're either a joint operation or a joint venture. And in all cases, equity method is used. And one is called proportionate allocation. I know they call it proportionate consolidation. I get confused myself because proportionate consolidation is no longer allowed, but they call it proportionate allocation. So you pick up your share of assets, liabilities, revenue, and expenses. Okay? Now, this question is all about the transferring of the asset from the venturer to the joint venture. And the first part says, assuming there is no commercial substance, what would the entry be on Clifford's books? And in part B says, assume that Clifford receives 40% interest and $1,000 cash in return for investing the equipment in the venture. Also assume that the other venturers contributed cash in excess of $1 million for their ownership interest and that the transaction did not have commercial substance when Clifford transferred. So let's do this together, all right? So Jaeger, or is it Jaeger? How do you pronounce this? Whatever. J, a joint venture, was formed on January 1st, year 3. Clifford, one of the 3 founding venturers, invested equipment for 40% interest of the joint venture. The other 2 venturers invested land and cash for their 60% equity. All the venturers agreed that the fair value of the equipment had the value of the equipment had a fair value of $2 million, and the remaining useful life of approximately 8 years. Clifford had acquired this equipment 2 years ago, and the carrying amount on the record on January 1st, year 3, was 1.8. Clifford records an investment in joint venture of $2 million, which makes sense because the fair value of the equipment was transferred was $2 million. On December 1st, year 3, Jaeger recorded a net income of $200,000. Clifford uses the equity method to record an investment. Okay, so first of all, the fair value of the equipment is $2 million, and the carrying value of the equipment on Clifford's books is $1.8 million. So we have a gain. And this gain is unrealized. Now, we're going to realize some of it if we end up getting cash, right? Or we end up getting a loan, right, within the joint venture. So, in the first part, under the Clifford's books, and we're using equity method, on January 1st, year 3, we need to record the investment. The investment in Jaeger. We're going to credit equipment. Obviously, if there was a cumulative amortization, we would do the same, right? We would credit the equipment, debit the cumulative amortization, and we would credit unrealized gain. And this would be a contra account, right, to the investment. Now, on December 31st, we would pick up our share of income. So 40% of $200,000 would be $80,000. So I would debit investment. Equity income from Jaeger. Okay, or if you want to call it investment income, whatever you want to call it, right? Now, with the unrealized gain, you have to amortize an unrealized gain. And we're going to amortize to recognize the gain that's transferred of the equipment to joint venture. We need to debit unrealized gain. And that would be the $200,000 divided by 8 years is $25,000, and credit gain on transfer, because presumably the equipment gets utilized and it's part of that whole income that you pick up, so you pick up your portion of that gain, right? As the asset gets consumed, you pick up your share of that gain. Does that make sense? Now, for part B, it says that Clifford got $1,000 or $1 million cash, right? So now you've got commercial substance. Sorry, they still don't have commercial substance. Okay. So first of all, what's the fair value of the equipment transferred? $2 million. What is the carrying value of the equipment? $1.8 million. Same analysis, except now I can recognize the profit. Why? Because I got $1 million cash. So I'm going to recognize the profit. So the portion to recognize due to deemed sale, which would be the $1 million cash that I got divided by the $2 million that I rolled in times 200,000 is 100,000, and the portion that's unrealized which is a contra account to the investment is 100,000. So the entry on my books is January 1st, year 3. I'm going to debit cash, 1 million. Debit investment, 1 million. That's for your 40%. Credit equipment, 1.8 million. Credit gain on transfer, 100,000, and credit unrealized gain, 100,000. Now, on December 31st, we're going to pick up our share of income, so debit investment in Jagger. Same calculations before. Equity earnings from Jagger. Now I need to amortize the unrealized gain. This time I only got 100,000 to amortize. Okay? So it depends on the cash proceeds. Right? And that would be the 100,000 divided by 8. Sorry for the writing, you guys. It's been a long day. But if you need some clarification, come upstairs. I have office hours right after. Okay? Okay. Our last question is 8-7. And this question is step down. And you saw one already on mock, right? You guys saw the mock exercise on step down? Okay. (8-7), please. Okay. Summer has the following shareholders' equity. Plummer held 90% of Summer on January 1st year rate, and the investment in Summer had a balance of 126 on that date. Okay, so let's do let's analyze, first of all, as we go through each one of these, let's analyze the various transactions, the various steps, right? So the total, parent, and NCI. So let's start with the investment. This is as of January 1st, year 8. And we own 90%. 126. So the implied value is 140. Take the 126 divided by 90%. Which means that the difference between 126 and 140 is the non-controlling interest. Now, whenever we do these things, there's usually only one asset, right? One acquisition differential. But if there was 2 or 3, it's actually not that much different, right? You just have to make sure that you track each one of them separately. In this case, we need to calculate that purchase price, that acquisition differential, and we're told that common shares, which are 4,000 shares, and retained earnings is 20, and 70, which is 90,000. So the acquisition differential, which is trademark, is actually, so 140 less 90 is 50. Now, we need to take 90 times 90%. This is 81. And the difference between the two is 45,000. And of course, this is 9,000. So now I want to make sure I'm allocating the trademark, which is the only. Now, if there was 3 assets here, you would just take the 50 trademark and whatever, let's say inventory, goodwill, you would do them separately. And every time you sell, because this is a step down, you would take portions of each one and move it over to the other side, right? Now, we found out that on July 1st, halfway through year 8, Plummer sold 720 shares of Summer at a price of 30. So, first I need to update prior to the sale, right? So I need to amortize the trademark. So it's 50,000 divided by 10 years. And of course, it's 1/2. It's 2,500. Why half? January to July 1st. Of course, I take how much of this? 90%. So the balance at 7/1 year 8 for trademark, this is before sale, is 47,500 and 42,750. Bless you. And I sold how much? 720 out of 4,000 shares, 20%. I'm going to take 20% of this and move it over to the non-controlling interest. You always calculate the percentage of sale based on who sold to whom, right? Because you still have control, you don't have to revalue. Once you pass that control, you do not do another acquisition differential calculation, right? Now, this is the balance as at 7/1 year 8 after sale, right? Now, what do we own now? We don't own 90 anymore, right? We own 72% now, right? I always like to keep track of what the new ownership is. It's no longer 90-10, right? By selling the shares, in essence, increase the non-controlling interest. So now I need to amortize. The amortization we know is 2,500 because that's the second half, right? And of course, I need to take 72% of 2,500 because now my new ownership is 72%, and that is 1,800. And of course, the amortization for year 8, the amortization for year 9 is 5,000. So now the trademark, so the balance at the end of year 9 before the new issuance, because what happened in year 9, we're told that Summer issued an additional 500,000 to a third party. By them issuing more shares to non-controlling interest indirectly means that our percentage goes from 72 to now a different number, right? A lower number, but we still have control because if you notice, we go down to 64%. I'll show you that in a minute, okay? So now we need to track. This is now the trademark balance. Now there's a couple things I got to make sure I pay attention to because I'm going to need this number when I do the analysis. So the first thing I need is I got to make sure that this amortization, okay, I'm going to track because those are the ones I've got to make sure I'm going to account for, right? But I'll show you what I'm going to use that in a minute. Can you guys stay for a bit? I just want to finish this part, okay? You don't have anywhere to go, do you? Okay. Now, what was my ownership before? My ownership, I had 4,000. I sold 720. So now I have 2,880. After, I still got 2,880, but now they issued more shares, 500 shares in fact. The new percentage ownership is 64%. So the difference is 8%. So 8 divided by 72 is like 1/9. So now I'm going to take 1/9 of this and move it over to here. So this is times 28,800 gives me 3,200, right? The key is you've got to somehow figure out by reading the entire question, when are these events occurring so that you'll know what percentage. If you still have control, which clearly, right, we still do, because we still have 64, which is greater than 50, all we're doing is moving. We're not revaluing the acquisition differential. All we're doing is we are establishing how much of these 80, unamortized 80, gets moved over to controlling interest or non-controlling interest. So, if we're asked to calculate, in this case, we're asked to calculate the gain or loss on those two events, we need to be able to update our investment under the equity method, right? So then we can figure out what the gain or loss is. So the next step I would do is calculate the investment under the equity method. Now I need to do this first because, and you'll see, if you didn't do this in its entirety, you'll notice that when you actually do the investment accounting and trying to figure out the equity method, you realize you need to update. So in a way, what I've done is I've kind of fast-tracked a bit, because I've already read the question, is I needed to do this so that I can complete the investment accounting. Okay, so let's do that next. So we need to calculate the investment. So on January 1st, year 8, we had 126. That was the original cost. Now we need to pick up our net income, our share of net income, which is 10,000 times 90%. Why 10? Well, I'm going to assume that that $20,000 for the year, halfway through, an average is half, right? I'm going to assume it's earned evenly. So this is kind of like the average, right, for 6 months. And that gives me 9,000. I pick up my amortization of AD, and that amortization was 2250, right? To give me 132,750. Then remember, I sold 20%, didn't I? Right? By selling, I'm going to multiply that by 132,750. I get 26,550. And by the way, what's the gain? Well, if this is the carrying value of my investment, what was the proceeds of disposition? What did I get for it? I got 720 shares times 30. That's 21,600. I have a loss. So given the fact that I sold those shares for $30, I have a loss, right, of 4,950. Does that make sense? Okay. Then I've got to pick up my share of net income. This is from July to December, right? This time I only pick up 72%, right? And I've got my AD. My AD amort was 1,800, wasn't it? Right? AD amort was 1,800. And then my dividends for year 8 was 5,000 at 72, because it was declared after I sold. It was declared at the end of the year, so I'm assuming I'm only getting in 72% of it. Then I got, this is the balance, year 8. Now, what is my net income for year 9? It was 28,000 times 72%. Because remember, when sub issued more shares, we assume it was at the end of the year. So throughout the year, we're entitled to 72% of that income. Dividends. And AD amort, right? And that one there, we're told, was 3,600. The investment is 118,800. Okay, so now I disposed 1/9 of it. How do I know it's 1/9? Well, I knew that, right? By looking at that 8% divided by 72. So I'm going to take this multiplied by 1/9 to give me 13,200. That's the amount of investment I've disposed indirectly. Now, what did I get in terms of cash proceeds? Well, Summer sold 500 shares times $46, right? Is 23,000. I own 64% of that. That means I have a gain of 1520. And the entry to that is you're going to debit the investment. You're going to increase the investment. So that's why you're going to add the gain here. Which is this gain here to give me my investment at the end of year 9. Okay, you guys? Any question? We just went through, I don't know how many chapters, right? 8, 9, 10, 11, 12. We went through 5 chapters. Afra.
I was just wondering why the loss wasn't included in the investment. Like the 49, was that different?
No, because you sold it.
Oh, right, okay.
Yeah, it's not there anymore, right?
So wouldn't you recognize that loss as part of, like, wouldn't you...
Oh, it would be part of net income of the parent, right?
Right.
Yeah.
But you wouldn't also reduce your investment by that amount. Oh, you did. Okay.
I did, yeah.
Okay.
I did. Didn't I? No? Okay. Yes? How much, what percent, what do you mean, time-wise? Are you talking about time? You know what I would do? I told you about the 10 minutes equals 10 marks. Did I tell you that story? So what I would do is I would take 3 hours, which is 180 minutes, subtract 15, so now you're down to what, 165? Divided by 100 marks is 1.6 minutes per mark. Then you see there's 35 marks in multiple choice, so what's that, Kyle? 1.6 minutes times 35, that's 56 minutes. I'd probably narrow it down to around 50, 45 minutes. So you use the number of marks as a gauge. And then you would adjust up and down. So if you're really strong at, I don't know, let's say we did that question on cash flow hedge. So let's say Sarwat is strong in that area, then she would just reduce the amount of minutes that she needs to spend there. And let's say you're strong on nonprofit, I would do that one more, less. So the answer to your question, it really is dependent, but it's going to be around 1.6 minutes to a mark. And then you save the last 15 minutes rereading your entire answer. Does that make sense? Did I answer your question, ma'am? Okay. Any other questions? Okay, so I guess this is our last class together, right, guys? So it's been my pleasure to have you all. I know I've seen you all in almost the last 4 years. For some that are new, hopefully you stay in touch and let me know if you become a CPA and we can celebrate and all that wonderful stuff. Keep in touch. All right? Thank you, and I'll see you on Saturday at 9 o'clock. Be there on time. And we're in the H wing, you guys. HW, where? 215, double check. Rosie. Oh, something's wrong with Rosie, and just go to the calendar. All right? Thank you, and have a great day.